Okay. Okay, let me set up my. No. I have like interview call, whatever, that's coming up. I'm gonna be talking to them. Let me move this here. I have an interview call coming up. Um, but we're just gonna do that. Hold on, let me do my microphone. Let me do my microphone. Gotta remove Bluetooth from my phone for the day. I gotta put a filter on the webcam. There's a filter on the webcam. Not the webcam, the microphone. What the fuck? Okay. Okay, I gotta open up my insurance folder, and also also the way I'm gonna do it is everything I do I'm just gonna live stream it from now on until family comes and stuff of that nature. You're just gonna have a random live stream, not insurance. Okay. Let's talk. Okay, industrial life insurance. Industrial life insurance issues very small face amounts, such as 1,000, such as $1,000 or $2,000. Premiums are paid weekly and collected by debit agencies that were designed for burial covered. Ordinary life insurance is life insurance of commercial company not issued on a weekly premium basis. It is made up of several types of individual life insurance, such as temporary, term, or permanent whole. Group life insurance is insurance written for members of a group, such as employment. Okay. Term life insurance gives you the greatest amount of coverage for a limited period of time. Term insurance is only good for a limited period of time because it has a term and nation date. Term insurance is an inexpensive type of insurance, making it an attractive option for large policies. Term life is the cheapest type of pure life insurance due to having a termination date and not having any cash value. It will always be cheaper than a whole life policy with the same fate. It provides a pure death protection since it only pays a death benefit if the insurer dies during the policy term. Under the term life insurance, there's a level term. There's something called a level term. It's also called level premium level term. Has a level face amount and level premiums. Premiums tend to be higher than annual renewable term because they are level throughout the policy period. Level throughout the policy period. However, the premiums will increase at each renewal. Life insurance run to cover a need for a specified period of time at the lowest premium is called a level term insurance. Decreasing term is a term life insurance that provides an annual decreasing face amount over time with level premiums. These policies are usually used for mortgage protection. A decreasing term policy is a type of life policy which has a death benefit that adjusts periodically according to a schedule and is written for a specific period of time. Decreasing term policies are usually written for mortgage or other debt that typically decreases over time until it is paid off. The way I'm going to do it, right? For now, when I get up in the morning, I have all these documents, right? I'm going to append them all. I'm going to append it to like a whole single document, and I'm going to listen to it until that listening portion is done. Then we're going to continue on and do the next couple of chapters. Then the next day, the listening portion is going to keep increasing the listening portion. So what I'm going to do, I'm going to have one single document. I'm just going to open up each document and just listen to it. A decreasing term policy is a type of life policy which has a death benefit that adjusts periodically according to its schedule and is written for specific periods. And decreasing term policies are usually written for mortgage or other debt that typically decreases over time until it's paid off. For example, a 15-year decreasing term policy could protect a 15-year mortgage. As the mortgage balance reduces each year, the phase of the insurance policy will be adjusted according to the match. After the mortgage is paid off, the insurance policy will expire. So, that's a good option. Credit policies are typically purchased using a decreasing term life insurance policy with the term matched to the length of the loan period and the decreasing insurance amount matched to the declining loan balance. Since credit life insurance is designed to cover the life of a debtor and pay the amount due to on the loan, if the debtor dies before the loan is paid, credit policies can only be purchased for them up to amount of debt or loan outstanding. Policy to protect $20,000. 5-year auto loan, you can use the 5-year decrease in life. Increasing term is a term life insurance. Increasing term is life insurance provides an increasing face amount over time based on specific amounts or percentage of the original face amount. Convertible term is a provision that allows policy owners to convert their term insurance into a permanent policy without showing proof of insurability. So convertible term, you can use like a decreased term, the term insurance into a permanent one into permanent policies. But you don't have to provide proof of insurability because you've been already insured, bro. That process already been taken care of when you did the term insurance. If we take out the conversion privilege of a group term life policy allows an individual to leave the group temporarily and convert to his or her insurance to an individual permanent policy without providing you. So you can leave a group one into a normal individual one. The most important factor to consider when determining whether to convert term insurance at the insurer's attained age or the insurer's original age is the premium cost. The number one factor which impacts life insurance premium cost is the insured current or attained age. For example, $25,000 policy on a healthy will cost substantially less than a $25,000 policy on a 57-year-old man. I see. Life insurance determined on your age. I think in my take with life insurance, it's one of the steep slope one because I'm not an American. I'm a Catholic. Well, I think I am. At least I think I am. That changes. I mean, I'm religious. I wouldn't say I'm a super religious, like super extreme religious person, but I believe in God and I believe in Christ. Yeah. But I wouldn't say I'm super religious and super extremist, super religious. I'm a chill dude. I just need God, man. It's scary out there without believing in a higher power, man. It's scary out there. Renewable term is a term insurance that guarantees the insured the right to continue term coverage after expiration of the initial policy without having to prove insurability. Renewable term is a term insurance that guarantees the insured the right to continue term coverage after expiration of the initial return policy without having to prove insurability. This cycle continues until you are too old to renew or to all term insurance have the final termination date where you can no longer renew it. Annual renewable term is a term cover that provides a level face amount that renews annually. This type of coverage is guaranteed renewable annually without proof of insurability. A term rider is a type of life insurance product which covers children under their parents' policy. Family plan policies usually cover the family head with permanent insurance and the coverage of a spouse and children is term insurance in the form of a rider. A term rider is always level term. This is cheaper than every family. I'm probably gonna get a call. I'm probably gonna mute the mic and shit like that. A term rider is always level term. This is cheaper than every family member getting the whole life insurance provides death benefits for the entire life of the insured. Insured means you. The insured, at least in the state of Michigan, means you. Insurer means the insurance company. It also provides living benefits in the form of cash value. It matures at age 100 and normally has a level premium. All whole life has the same type of benefit. The only difference in types of whole life is how the policy is paid. Some will be paid to straight death or age 100. Some will be paid for after a few years or by a specific age. Some may give you a little discount in the early years to help you get started. All whole life lasts until death or age 100, has a fixed premium and level benefit with cash value accumulation. Regardless of how it is paid, whole life is often compared to buying, like buying a house. With whole life, you have straight life insurance, which our premiums are payable throughout the insurer's lifetime, and coverage continues until insurer's death. Said differently, premiums are payable as long as the coverage isn't enforced. Like all of them, provide fixed premium, a level death benefit, and cash value. Whole life also requires the face amount to be paid out to the insured at age 100 when the policy matures. So if you survive at 100, they gotta give you your cash, bro. Yeah, they give you money. Straight whole life allows you to maintain coverage throughout your entire lifetime, but the cost. I mean, the only thing I would life insurance, if you have a family, you have kids, you have a mortgage, you have a mother, it's like it's one of those things that you have to think about. They'll pay the cost for your fucking funeral. God forbid this happens. They'll pay the cost for your funeral, so your family, all your family has to do is bury your grief. You don't have to worry about the money. Oh, Papa did this. Papa set us up. I don't have to. Papa did something good. Damn, Papa did that. Though we don't have to worry about it. Papa did what he needed to do to pay the mortgage. He paid the mortgage off. Now we don't have to live on the streets. It's that reason. It's the insurance, life insurance. It's life happens. You can't do nothing about it. Life happens and you can't do nothing about it. With whole life limited pay, the coverage remains on a limited pay life policy until age. Even though premiums are limited to a certain period, the insurance protection extends until the insurer's death. So limited, you'll pay until that time, and you have life insurance for the rest. Whole life modified is a policy where the premium stays fixed for the first 5 years and increases in year 6 and stays level for the remainder of the policies. Okay. Has the same feature as any other whole life, except the insurance company cuts you a break on premium for the first few years. So basically, first 5 years while you're getting your life in order, you have this 6-year hits, you get charged up the wazoo, and it stays at that level. That's interesting. Whole life modified endowment contract is best described as a policy that exceeds the maximum amount of premium that can be paid into a policy and still have to be recognized as life insurance. MAC does not meet a 7-day pay test and is considered overfunded. According to the IRS, for that reason, the policy will lose favorable tax treatment. The test is designed to discourage premium scale that would result in a paid-up policy. A joint life policy covers the lives of two individuals and saves on premium costs by averaging the age of the two insured. Joint life policies pay the face amount after the first person called. Joint survivor and last survivor life policies cover the lives of two individuals and save on the premium cost by averaging the deaths of the two insured. Okay, so joint survivor or life survivor. If two or four people are you get life insurance. Once the four die, or the last person, it's like a bet. Who dies between us? The last person who does not die. Oh no, when we have four people in the joint survivor, life survivor. Once all four dies, then you get the money. Okay. Hello. Well, death benefit. The investment gains from the universal policy usually goes to the cash value the policy owner uses. Variable life insurance policies require a producer to have proper FINRA and National Association of Securities Dealers securities registration prior to selling any, whether it be life insurance or annuity, as they include regulated securities. These policies are also known as interest-sensitive policies. The policies usually have a fixed level premium. With variable universal vol, the policy owner controls the investment cash values and selects the timing and amount of premium payments. Variable universal policies give the policy owner the best of both variable life and universal life. Equity index universal life insurance. Equity index universal life insurance, or equity index life, combines most of the features, benefits, and securities of traditional life insurance with the potential of earned interest based on the upward movement of an equity index. Unlike a traditional whole life, this plan allows policyholders to link accumulation values to an outside equity index like the SP 500. 89% of the premium is invested in traditional fixed income security, and the remainder of the premium is invested in contracts tied to a stipulated stock index. These policies are guaranteed by a guaranteed minimum interest rate, tax deferral, blah, 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 blah. With an investor or stranger originated life insurance policy, SIOLI, when the insurer dies, the policy owner investor benefits. The beneficiary with insurable interest who benefits from death of the investor, original personal policy on the life of someone else to profit upon that person. Ew. Investor typically policy owner, payer, or name themselves. This is nasty, bro. Ugh. That turned my stomach. Cash value is the equity amount or savings accumulation in the whole life policy. The endowment policy is a contract providing for payment of the face amount at the end of the fixed period. A face amount plus cash value policy is a contract that promises to pay at the insurer's death the face amount of the policy plus sum equal to the policy's cash value. Juvenile insurance is written on the lives of the children who are within specified age limits and generally under parent control. Non-medical life insurance typically does not require a medical exam and tends to be more expensive than medically underwritten policies. The insurer will average out everyone's risk and charge accordingly. Target premium is a suggested premium used in the universal life policy. It does not guarantee there will be adequate funds to maintain the policy at any time, especially to life. Types of life insurance policies. Industrial life insurance issues. Insurance issues very small amounts, such as 1,000 or 2,000. Premiums are paid weekly, collected by debit agency. They were designed for burial coverages. I'll be honest, 1,000 or 2,000 in this day and age does not cover burial. It does not, bro. It does not. Group life insurance. Group life is insurance written for members of a group, such as place employment, associate, or a union. Coverage is provided to the members of that group under one master contract. The group is underwritten as a whole, not each individual. One of the benefits of group life coverage is usually there is no evidence of insurability required. Ordinary life is made up of several types of individual life insurance, such as temporary, term, permanent, whole. Term life insurance gives you the greatest amount of coverage for a limited period of time. Term insurance is only good for a limited period of time because it has a termination date. Level term, also called level premium, has a low face value and low premiums. Decreasing term life insurance that provides an annual decreasing face amount over time with lower premiums. These policies are usually used for mortgage protection. Credit policies are typically purchased using decreasing time life program with the term matched to the length of the loan period and the decreasing charge amount matched to the declining loan balance. Increasing term life insurance that provides an increasing face amount over time based on specific amounts or a percentage of the original face amount. Convertible term, a term policy that has a provision that allows policy owner to convert term insurance into permanent policy without showing proof of insurability. Renewable term insurance that guarantees the insurer the right to continue term coverage after expiration of the initial policy period without having to prove insurability. Annual renewable term coverage that provides a level face amount that renews annually. This type of coverage is guaranteed renewable annually without proof of insurability. Term rider, which covers children or under the parents' policy. Whole life insurance provides death benefit for the entire life of the insured. Also provides living benefit in the form of cash values. Whole life insurance provides both living and death benefit, provides permanent life protection for the insured's child life. It also provides living benefits such as cash and policy. Advantages of whole life insurance cover the entire life of the insured, living benefits, which are cash values and policy loans, and fixed premiums. Drawbacks of whole life insurance: protection is more expensive. Premium paying period may extend beyond the income unit years. Whole life is often compared to like buying a house. Types of whole life insurance are straight whole life, limited pay whole life, single premium whole life, modified whole life, and graded whole life. Straight life is basically the whole life and whole insured with level face amount and fixed premium payable of the insured entire life. Premium until the death of insured or age 100. Limited pay life. This life insurance, where insurance is covered by entire life, but premiums are paid for a limited time. As the premium payment period shortens, cash value increase faster, and the fixed premiums are higher. For example, if it's up to 65, it keeps going. It keeps increasing every year, or every 5 years, every 10 years. It increases at a drastic rate. Single premium whole life. Single premium whole life allows the insured to pay the entire premium in one lump sum and have coverage for the insured's entire life. An immediate non-forfeiture value A large part of the premium is used to set the policy reserve. Modified whole life, low premiums in the early years and jumps to a higher premium in the later years, remains fixed thereafter. Premiums increase just once. Graded whole life. Under a typical graded premium life insurance policy, the premium increases yearly for a stated number of years, then remains level. Premium continues to stay level for the remainder of the policy. Increases yearly. Special use. In addition to basic types of life insurance, there are a number of special use policy insurance companies offer. Many of these are a combination of or packing of different policy types designed to serve a variety of needs. Family plan policy deals to insure all family members under one policy. Usually, the family head is covered as permanent, and the spouse and children are included in the same policy as level term life riders, family term riders. The term cover are normally convertible to permanent without if attached to someone else's property. Think sidecar on a motorcycle. Riders must ride on something. Family plan policy. Husband, wife, term policy, convertible. While the children are term policies. Convertible, usually aged at 18 to 21. Family income policy. Whole life and decreasing term insurance begins date. Provides monthly income to a beneficiary if family maintenance policy. Whole life and level term begins date of death. Family income policy. Whole life and decreasing term provide monthly income to a beneficiary if death occurs during a specific period after the purchase. Only the face if the insurer dies after the specified period, only the face value paid to the beneficiary, since the decreasing term life insurance expired. So if you mortgage, you pay it off. But since you pay it off, only the face value. Family maintenance policy. Whole life and level term begins date of death. Level term begins date of death. Provides income to a beneficiary for a selected period of time if the insurer died during that period. At the end of the income period, the beneficiary also received the entire face amount of the policy. If the insurer died after the end, it's like multiple protection. Like, this is one of the things where I understand as an adult, there are bills when you die. You just don't die, and people actually, oh my God, it's free. No, it's a business. And the business of death, and I don't like businesses in death. But I understand life insurance, specific life insurances, where you have to say yes. There are bills to pay, and I think life insurance is needed to if you have children. No, I don't think. The only thing, if you have children, I do agree you need life insurance. But if you have just a wife, no. Unless you've been with her. Like my personal belief is you keep it on the down low. You keep it on the down low. On the down low, bro. You don't tell no one if you have a life insurance, because people get crazy. Multiple protection policy pays the benefit of double or triple the face amount if death occurs during a specified period. Joint life policy that covers two or more people. The age insurers are averages and a single premium is charged. It uses permanent insurance as opposed to term. Pays the debt when one of the insured died. Note a variation of joint life policy is the joint and survival policy or survivorship policy. This plan also covers 2 lives, but the benefit is paid upon the death of the last surviving member. Juvenile insurance, life insurance, which is written on the lives of minors, is called juvenile insurance. The adult applicant is usually the premium payer as well until the child comes of age able to take over the payments. A payer provision is typically attached to juvenile policies. Credit life insurance is designed to cover the life of the debtor and pay the amount due on the loan if the debtor dies before the loan is repaid. I want to see something. Non-traditional life insurance, blah, blah, blah. Interest sensitive is a type of whole life insurance where the cash value can increase beyond the stated guarantee if the economic conditions warrant. Adjustable life policies are distinguished by the flexibility that comes from combining term whole life insurance in a single plan. The policy owner determines how much of the face amount protection is needed and how much of the premium policy wants to pay. Adjusted life insurance allows you to vary your coverage as your needs change without requiring evidence of insurability. Consequently, no new policy needs to be insured when changes are desired. Adjustable life has the usual features a level premiums, cash value, life insurance. Universal life is a variation of a whole life insurance and characterized by considerable flexibility. Changes may be made with relative ease by the policy owner with these flexible premium policies. Investment gains goes to cash value, unlike whole life with a fixed premium, the fixed face amounts, fixed cash accumulation. Universal life policy allows the owner to determine the amount and frequency of premium payments, which will adjust the policy face amount. Equity Index Universal Life Insurance, EIUL, is a permanent life insurance policy that allows policyholders to tie accumulation value to stock market index. Modified endowment MEC is a policy that is overfunded according to the IRS tables. Classified as modified endowment policies that do not meet the 7 pages are considered MEC. You'll lose tax. And there's penalties. Taxation only occurs when cash is distributed. Variable insurance product. Variable whole life insurance was created to help offset and affects inflation on death benefits. It's permanent life with many of the same characteristics and many different in the manner which policy values are invested. With traditional whole life, these values are kept in the insurance general account and invested in conservative investments by the insurer to match the contractual guarantees of liability. With variable life insurance, the policy values are invested in the insurer's separate account, which houses common stock, bond, money market, other security. Values held in these separate accounts are invested in riskier but potentially higher yielding and assets are fixed premiums, guaranteed minimum death benefit, which fluctuates over the minimum, and cash values, which fluctuate and are not guaranteed. Variable and universal life. Vol is a type of life insurance that builds cash value. It combines all the characters of a universal life and variable life. In a vol, the cash value can be invested in a variety of separate accounts similar to mutual funds. Choice of which of the available separate accounts to use is entirely up to the contract owner. The variable component. When death benefit has increased. Okay, let's do chapter 1 exam. An interest-sensitive life insurance policy may be able to draw partial surrender. Hello to Duvient, how are you today? As my restream is not showing me the emotes. Hello? Hello. I like that Patrick Larkin one. Which policy feature makes a universal policy different from a whole life policy? No, a flexible premium schedule. Okay. Which of the following are the premium payments not used for? Cash value. No, separate account investments. How are survive helpful in estate planning? Yeah, they provide funds to help. Which of the following policy does not build cash value? Term. What's the type of life insurance offer flexible premiums and flexible variable? Yep. What types of life insurance are usually used for key employee indemnification? Term, whole, and life insurance, and universal life. What is the automatic continuance of insurance coverage referred to as? Renewal. Unlimited payment whole life policy provides protection for 20 years. No, limited life, huh? Oh, it's limited. But Reggie purchased a life insurance policy with a face amount of 500 grand. After 15 years, the cash value has accumulated to 100,000, and the policy's face amount has become 600,000. It's adjustable life. No, universal. Rob purchased a standard whole life policy with a 500,000 death benefit when he was age 30. His insurance agent told him the policy would be paid up if he reached 500,000 because he died at that age. Variable life insurance which one of these features are held exclusively by variable life insurance? Yep. Variable different because the policy owner has the right to select. Under a modified endowment contract, pre-death distribution will become taxable. A life insurance policy that has premiums fully paid up within a stated period of time is called the limited payment insurance. The premium for a modified whole life policy is I think that one. No, lower than the typical whole life policy during the first few years, then higher than the typical. Which of these describe the result of modified endowment that have failed to meet this? Yep. All these characters of universal life policy except flexible premiums. Fixed or undervalue. What happens to the coverage under a children's term when the right coverage is eliminated? Donald. Donald's the primary insured of a life insurance policy and as a children's. Julie has Someone I know. Julie has $100,000 30-year mortgage on a new home. What type of life insurance could she purchase? A decrease in term insurance. Is it adjustable? Yeah. When a decreasing term policy, it contains a decrease in death benefit and increasing premiums. No, level premiums. Okay. Peter has 89% premium is invested in traditional fixed income security, and the remainder. This is equity. What is a corridor in relation to a universal? The gap between the total death benefit and the policies. Shirley has a $500,000 10-year non-renewable term level. I scored 60%. He's 75. Time to do it again. Time to do it again. But by reading that, I did it again. What happens to the cover under a insurance term rider when a child reaches a specific age? Coverage is eliminated. Donald is the primary insured of a life insurance policy and added. Can be converted. How is survivor helpful? It provides funds to help pay taxes. Level premium permanent insurance accumulates a reserve that will eventually pay a dividend to the equal to the face amount of the policy. A life insurance which contains cash value that vary according to it's called a modified whole life. No, variable whole life. Which type of policy combines the flexibility of a universal life policy with investment choices? That's modified. That's very. Oh my god. The least expensive option to pay off would be a decreasing term life. Which of these describe the result of a modified endowment that have failed to meet? The premium payment will be tax deductible. No, pre-death distribution will be tax deductible. A single premium cash value can be described up. Yep, a single premium you pay it off once. I'll purchase. The cash value. No, the face amount. Level means the face amount. Okay. But a predetermined age. A renewable term life insurance policy can be renewed. Regularly per. Universal life. Yep. A business will typically use which type of life insurance? It's a group policy. All these things concerning whole life insurance are false. Policy owner can take a policy on loan to replacement. Coverage is not normally temporary. No. What type of multiple protection policy pays death survivorship? What is the automatic issuance? Death renewal. All these valid options for adjustable. Yeah, increasing the death amount by using one or more. The type of multiple protection cover that pays on the death of the last person is called survivorship. They give this adjustable. Variable. Partial surrender. This is an equity index. Level premiums. 64%, 64, 64, 64, 4, 4, 4, 4. Family term. Are not used for separate account investments, no. A securities license card for variable life insurance. Family term. Pay. What's wrong with the? Yep, a payer benefit rider waives the premium only in connection with a juvenile insurance. Increase in term life policy? No, universal life policy. Leverage. Cash value is higher than the IRS will allow. Okay. Death benefit. Yep. The death benefit would not be subject to income tax under a modified endowment contract with an adjustable life. Which of the following policy does not build cash value? Variable life. No, term. Increase in term life. What is a quarter? The gap between, no. It's a gap between the total death benefit and the policy's cash value. What types of life insurance are normally used for employee indemnification? Term, whole, and universal life insurance. Jonas? Toyota, no, it's child term rider. It's gonna say variable. Yep. Endowment policy. It's provide coverage for a home. Mortgage. What policy makes it? A flexible premium schedule. Of face out premium. A face out premium permanent insurance accumulates reserve that will eventually become larger than the face amount. No, equal to the face amount of the policy. Yep. Pays a death claim in the amount of death benefit plus the savings element. This is equity. Limited pay policy. A business would typically use which type of life insurance to cover a group policy? I'm at 68, bro. 68, bro. 68, bro. 68. Group policy. when a whole life are false, except when a whole life are false. Are these full covers? No. No. Family term insurance writer. Yeah. Premiums are the pre-death distribution will become taxable. What type of life insurance are normally used for key employment indemnification, term, whole, and universal life? The statement which best describes the relation between premiums of a whole life policy and the premium payment method. The shorter the payment period, the higher the premium. This is universal life. Survivorship. I want to say variable life. No, term. Seek temporary protection. It's a hedge against inflation. That's a joint. It's a stated payment insurance. No, limited payment insurance. Endowment. Yep. Pays the face amount at the end of the specified period. Which type of multiple protection policy pays the death of the last person? So, survivorship. I want to say credit life, not universal life. Equal to the amount of the policy. This is equity index. No. Proceeds will no longer have insurance protection. Flexible payment schedule. Pay your benefit rider. Join us as a whole life insurance policy owner. Would like to add coverage. We call those child term riders. Okay, now it's time to go to exam 2. This says 16. Okay, time to drink 10 pulses of water. You gotta wait, man. You gotta wait, man. You gotta wait, man. Absolute assignment. Absolute assignment is a policy assignment under which the assignee person whom the policy is assigned receives full control of the policy and full rights to the benefits. Generally, when a policy is assigned to secure a debt, the owner retains all rights and the policy in excess of the debt, even though the assignment is absolutely informed. Accidental death benefit, multiple indemnity rider. Pays additional sum to the beneficiary if the insurer dies due to a covered accident. The amount paid is a multiple of the policy face amount, such as double or triple the original. Auxiliary benefits rider. The auxiliary benefits rider allows the insured to receive a portion of the death benefit before death if the insured has a terminal illness or expected to die within 1 or 2 years. Whoever will bequeath the death benefit. Like, it's in cases like this, terminal illness, man, where life insurance will help. You won't be in the zero. Accumulated interest option. The accumulated interest dividend option allows the policy owner to, and it's these, like taking $15, $20. That's a meal, bro. Maybe 30. That's a fucking meal, bro. That's going on. That's 2 McDonald's. You can skip 2 McDonald's and pay for your family's insurance. That God forbid something happened, I don't have to worry. I can take the worry out my soul. I will have to worry, but they'll be covered. They can go on life. The house will be paid for. The house will be halfway paid for. They can live. All they have to do is worry about electricity, heat. That's a normal job. Accelerated benefit rider will allow the insured to receive a portion of the death benefit before death if the insured has a terminal illness and expected to die within 1 or 2 years. Accumulated interest option. The accumulated interest dividend option allows the policy owner to leave dividend with the insured to accumulate interest. In turn, the policy owner is required to pay taxes on any profit interest generated by the dividend. Assignment clause. The assignment clause allows the right to transfer policy rights to another person or entity. Automatic premium loan provision or rider. The automatic policy loan provision allows the insurance company to deduct the overdue premium from the insured's cash value by the end of the grace period if a payment is missed on the life policy. The insurance company can automatically take out a loan for you. Oh, shit. Against your cash value to cover your premium if they don't receive the premium when due. This automatic. Oh, shit. Ew. What the fuck? Ew. Cash up. The cash dividend option allows policy owners to cash out the dividends they receive. Cash surrender option. The cash surrender non-forfeiture option allows the policy owner to receive the policy's cash value. The policy owner no longer has coverage at this point. Usually the maximum time may legally defer to paying the cash value. Collateral assignment. Collateral assignment is an assignment of a policy to a creditor as security for a debt. The creditor is entitled to be reimbursed out of the policy proceeds for the amount owed. Consideration clause. The consideration clause states a policy owner must pay a premium in exchange for an insurer's promise to pay benefit. A policy owner's consideration consists of completing the application and paying the initial premium. The amount and frequency of the premium payments are contained in the consideration clause. Dependent riders or other insured riders. Dependents may be added as an additional or other insured through the use of a dependent rider. Other insured riders typically used for spousal insurance. Dividend options are options a policy owner has when receiving dividend payment from an insurance policy. Entire contract provision. The entire contract provision or clauses state the insurance policy itself, any riders or and endorsements, the applicant compromises the entire contract between all parties. Exclusions. Exclusions are features of an insurance policy stated that the policy will not cover certain risks. Extended term option. The extended term non-forfeiture option permits the policy owner to use the policy's cash value to buy level extended term insurance for a specified period. No further premiums are made. The coverage provided with extended term non-forfeiture option is equal to the net death benefit of the last policy. Free look period. The free look period states the policy owner is permitted a certain number of days once the policy is delivered to look over the policy and return it for a refund of all premiums paid. Grace period. The grace period is a period for after the due date of a premium during which the policy remains in force without penalty. If the insured dies during the grace period of a life insurance policy before paying the required annual premium, the beneficiary will receive the face amount of the policy minus any required premiums. Grace period. The grace period is a period after the due date of a premium during which the policy remains in force without penalty. If the insured dies during the grace period of a life insurance policy before paying the annual required premium, the beneficiary will receive the face amount policy minus any required premiums. Any required premiums. Any required premiums. Guaranteed The guaranteed insurability rider permits the policy owner to buy additional permanent life insurance coverage at a predetermined interval without submitting proof of insurability. Also includes specific events like marriage and birth without requiring proof of insurability. Usually the benefit is allowed every 3 years of the original face amount of the policy. Incontestable provision period. The contestable provision states that an insurance company may not challenge the validity of a policy once the policy has been in force a period of time, typically 2 years. Insurance clause or insuring agreement. The insuring agreement is the insurer's basic promise to pay specific benefits to a designated person in the event of cover loss. States the scope and limits of coverage we insure to insure you for. Misstatement of sex, misstatement of age or sex provision. Misstatement of age or sex provision allows the insurer to adjust policy benefit if the insurer's age or sex is misstated on the policy. Non-forfeiture options are the options you have for your cash value if you terminate a policy that has a cash value. You are closing your account, surrendering your policy. What do you want to do with your cash so you don't forfeit it? 1 year term option. The 1 year term dividend option allows the policy owner to exchange the dividend for additional coverage in the form of a 1 year term policy. Paid up option. The paid up additional dividend option allows the policy owner to exchange the dividend for additional single payment whole life policy. Payer provision, rider or clause. A payer provision waives future premium for a juvenile life insurance policy if the person responsible for paying the premium dies or becomes disabled. Policy loan cash withdrawal provision. The policy loan provision applies to policies that have cash value. Also have policy loan and withdrawal provision. These policies must begin to build cash value after a certain number of years. In most states that is 3 years. Reduced paid up option. The reduced paid up non-forfeiture option allows the policy owner to reduce the policy's benefit amount and insurance cease making premium payments. Reduced premium option. The reduced premium dividend option allows policy owner to return the dividend payment to the insured in exchange for reduction in the following year's premium payments. Restatement provision. restatement provision is putting a last policy back and forth by producing satisfactory evidence of insurability and paying any past due premiums required. It permits the policy owner to reinstate a policy that has lapsed as long as the policy owner can provide proof of insurability and pay back all premiums, outstanding loans, and interest. Return of premium rider. The return of premium rider pays the total amount of premiums paid in the policy in addition to the face value, as long as the insurer died within a specific period specified in the policy. Suicide clause. Within 2 years from the policy issuance. Yeah, makes sense. Oh my god, if Twitch is still on their stupid shit. I have a webcam downstairs. Waiver premium rider allows the policy owners to waive premium payments during disability, keeps the policy. The entire contract clause provision is found at the beginning of the policy. The preference of change clause or policy change provision outlines the conditions under which the company will allow the policy owner to change the policy's coverage. The insurance clause or agreement sets forth the company's basic promise to pay benefits upon the insurer's death and specifies the amount and frequency of premium payments. I'm going to like 5, you know what I mean? Doing this to 5, like a couple hours. Today I had doctor's appointments. I might make a TikTok about it. The execution clause or provision specifies that after a certain period of time has elapsed, usually 2 years from the issue date, the insurer no longer has a right to contest the validity. That's some titty. No. Validity. No. Validity. 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 I know how to say validity. Validity. The fuck? It's just the word. This is just the word validity. Validity. That messed me up, bro. That messed me up. Settings, output, recording. The incontestable clause allows the insurer to contest a claim during the contestable period. However, statements related to any sex and gender can be contested at any time. The company reserves the right for payment adjust if the age of the insured is misstated. Death caused by suicide is excluded during the initial period of time as the policy becomes effective. Owner's prevention or rights of policy ownership states that the policy owner possesses all rights contained in the policy. The primary rights of a policy owner include the right to assign or change the right to determine how proceeds will be paid, the right to terminate the policy and select the non-forfeiture option, the right to determine ownership of a policy to someone else. I don't know, man. Like, being Catholic, I don't know how I feel about But life, I don't know how I feel, man. And that's the biggest thing. The right to assign and change the policy benefit. The right to determine how proceeds will be paid. The right to terminate the policy, select the non-forfeiture option. The right to determine and change the premium payment schedule. Right to assign ownership. The right to decide what happens if it's in. The right to convert. Absolute assignment of an insurance policy involves the complete transfer. The absolute assignment of an insurance policy involves the complete transfer of the policy to the beneficiaries and assignees are entitled to proceeds upon the death of an insured before any claims of the insured's creditors. Irrevocable beneficiary means the beneficiary cannot be changed. There are two types, absolute and collateral. Mode of premium states that premium must be paid to an insurer or its representative in order for coverage to be provided. Allows the policy owner to select the mode of premium. Free look provision allows the policy owner to return the policy for a full premium refund without giving the reason to the insurer. The grace period in life insurance is meant to protect the policy owner against the intentional lapse of the policy. The reinstatement period allows the insured to reinstate a lapsed insurance policy. Typically, this is done within 3 years of the policy lapse, but some may allow as long as 7 years. If the insurer does not accept the non-forfeiture option, prevent the policy owner from forfeiting a policy's cash value if they decide to. There are three non-forfeiture options: cash surrender, reduced paid up, or extended term option. The cost recovery rule states that when a life insurance policy is surrendered for its cash value, the cost basis total premiums paid exempt from taxation, but not the other ones. The extended term insurance option provides the insured with the most insurance protection in the event of voluntary policy surrender or non-payment of a premium. The primary advantage of a policy loan is that it provides ready cash for the policy owner without having to apply or qualify for the loan. The automatic premium loan provision allows the insurance company to automatically take a loan against the policy's cash value to pay the premium due if the required premium is not paid by the end of the grace period. The spendthrift clause stipulates that a settlement option may be selected by the policy owner at the time of the application. The accelerated benefits let me see. There's a Google Pixel tablet. See how much it costs. Google Pixel tablet. Ah. Okay, guys, let's continue. First of all, okay, let me see. Oh, there's one person from Twitch. Not from Twitch, whatever it's called. Twitter. Why is this trending? Okay, the automatic premium loan provision allows the insurance company to automatically take a loan against policy. Administrative clause stipulates that the settlement option may be selected by the policy owner at the time of expense. Accelerated benefits provision, also known as living benefits or terminal illness rider. If certain conditions are met, catastrophic illness covers only identified listed disease in the policy, such as cancer, heart disease, renal failure, or stroke. The long-term care rider will generally pay benefits when insured cannot perform at least two of the daily activities of daily living. Activities of daily living include eating, dressing, bathing, toilet or continence, walking or ambulation, transferring or taking medication. There are two different ways a long-term care rider approaches: generalized or independent approach, integrated approach, and insurance dividend is not considered to be taxable income. A policy that provides a choice of dividend option must include a statement that the dividends are not guaranteed. Dividend options include cash, reduced, reduction, or suspension of premiums, paid up permanent addition, 1 year term insurance, or accumulate interest. One of the unique ways life insurance contract is the ability the applicant usually waiver cause disability provides an income benefit of the insured is totally permanently disabled. Policy that pay a multiple of 2 times the policy amount are called double indemnity, and those that pay 3 times the death benefit for death accident are called triple indemnity, and so forth and so on. The death benefit paid under accidental death coverage is called principal sum. The severance dismemberment benefit paid under accidental dismemberment is called the capital sum, and usually 1/2 of the principal sum. Guaranteed insurability option allows policy owners to purchase additional life insurance coverage at specified dates without providing evidence of insurability. Pay your rider, level term. Yep. Which division option would an insurer invest the policy owner's money at any interest earnings? Accumulated interest option. During exit a non-forfeiture option by using the life policy's casualty to purchase an extended term protection ends, of course. What's the part I have an accelerated death benefit? Yeah, accelerated death benefit is considered to be a living benefit option in insurance. The waiver premium, no partial surrender. The suicide clause, if minus indefinite and without interest. Loans obtained again. Will not be treated as taxable income. Collateral assignment. Policy of the decreased face amount. All the following are considered not. Reduction of premium. Accumulate. An error was made in its age. A life insurance does not have a right to revoke an absolute assignment. Yep. In order to activate an standing clause of a law and provide evidence of insurability to insure. Okay. Commercial aviation. Yeah. War, hazard, suicide, hazardous jobs? No, but commercial aviation, yeah. The free look provision gives the policy owner Yep. Which of the following protects the policy from misrepresentation caused by innocent mistake? Is it incontestable clause? Well, I thought with that. The 1 year term. Accumulation of interest. Oh yeah, because profit. Which is not considered to be a non-forfeiture option in the whole life. Interest only, okay. After the premium is due, which type of rider will waive? Pay your benefit. Okay. All these are common exclusions to life insurance except hazardous occupations, accidental death. Life income annuity. A guaranteed issue. I got 40% on it. During exercise of the non-forfeiture option by using his life's protection ends. Waiver of premium. Entire contract. Yep. Completely and permanently disabled. A whole life accumulates cash value that becomes Yep. Of the following dividend, which of these are taxable? Accumulation of interest. Which of the following protect the policy owner from misrepresentation? I'm gonna finish. I'm done with insurance for today. Five o'clock I finish. I get up in the morning. 5. Work all the way till 5. Go rest, then come back, and we're gonna do some other shit. Alright then. I'll see you guys later.